Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I am joined by the greatest trader Wall Street has ever seen. The one, the only, Anthony Esposito. Anthony, how are you doing today?
Mr. President, very nice to be with you today. You threw me off with the Trump impersonation right off the bat. I'm good, AJ. I'm good. Definitely moving through a crazy quarter, crazy month, and crazy year, but all's good. Very, very happy to be on with you today, as always, because we had some good but kind of diamond in the rough economic data this week. And we clearly saw the media jump on it. The left-wing media is really, the financial media is just off the charts, always looking for something bad under President Trump. They can't not cheer for the market and they can't not boo President Trump. They're just kind of conflicted because they're kind of starting to work hand in hand. GDP came out last week. And we had first quarter GDP, and it was a decline of 0.3%. Everybody freaked. Market actually reacted pretty negatively to start, and then caught some footing and kind of ground higher. We'll get to the market in a minute. There's something deeper to the report. You were out on it, and I do mean this. You were the first person I saw out on it, kind of digging into the numbers and showing the positives there, and then I saw everyone else follow. Stephen Moore and Kudlow and everybody kind of jumped in and was on it. But yours was the first one I saw. Talk to me a little bit about that. What was positive? What was negative? What did the report really look like? And what does core GDP look like? Core GDP.
Yeah, great. So great questions, Anthony. I would say the biggest positive, if you will, in terms of good news was actually negative. In other words, government spending, you can see this in the chart here, government spending, or really it's government purchases, since it doesn't include things like transfer payments, welfare. This is just what government directly buys. So think of it as government buys concrete or asphalt to pave a road, okay? So these government purchases declined. They dropped so much that it contributed about 0.25 percentage point negative to GDP. So 0.25% down. The overall figure was 0.3 down. In other words, almost all of the decline in GDP can simply be accounted for by the fact that government is spending less money. That's great news, right? That's what I mean. The positive is the negative here. The good news is something that decreased. But the thing that really, really stands out, you can see it's this massive decline there, is imports. And imports and exports together create a category in GDP we call net exports. This was the biggest negative contribution that net exports has ever had to a GDP report. I mean, that's tremendous because these things go back to the 1940s. So we're talking about a huge, huge drop here. All right, so why did imports explode? Because imports going up pushes GDP down. And we can get into why that is in a second here. But basically what's happening is the fact that people are trying to front run tariffs. People are trying to get stuff into the country, whether it's business inventories or equipment, whatever the case may be. People are trying to get stuff into the country before these trade taxes get put in place. So it's just the front running of tariffs. Folks are trying to get ahead of it. That's what happened here. In terms of where does this show up? Well, the reason that investment absolutely explodes, you can see a huge increase. It added almost 4 percentage points to GDP. The reason for that has to do with not only what we're producing here in terms of the business inventories we're producing, in terms of the equipment that we're producing, but all of the stuff that we're importing, these consumer products, let's say, that are going to get resold, or industrial inputs, things like crude oil that we're importing that we're then going to refine and send around the world. That gets factored in as well. And what's interesting is that there was a huge gap. And this is where we get to your question on core GDP. If we're just looking at the stuff that we're making here, the stuff that we're consuming here. So you get rid of government, you get rid of net exports. We actually saw a big increase. So then the question becomes, why did we not see all of the imports filter through to either consumption or investment? And that just has to do with some of the lags here. When stuff is coming across the border, Anthony, it's really easy to add that stuff up essentially and get it into the report in a timely manner. But what we saw, particularly in the month of March, was the big explosion in terms of imports, and not all of that was basically in the country long enough to show up in terms of larger equipment stocks and larger stockpiles in terms of wholesale and retail inventories. Okay. In other words, some of the investment category here is actually missing. Now, it's going to get included in later reports, so it's not as if the numbers just vanish into thin air. But literally, I mean, I don't know, maybe it was an hour or two after I posted this, you had folks from the White House on the phone with the Commerce Department asking them, guys, where is like $300 billion of investment? We're not finding it as we go through these numbers, right? You see additions in category A, it should match additions in category B. You're importing stuff. Where is it showing up elsewhere in the report? That's the whole reason we subtract imports. It's because this is stuff that's getting consumed here, but it didn't get produced here. It's also the reason why we have to add exports. That's stuff that's not going to show up in terms of domestic consumption. Yep. But we did produce it here. And if GDP is supposed to be a production of things we're producing domestically, we need to account for all that. So again, you had a great point when you were asking, what about core GDP? Those numbers are doing just fine. I mean, the idea that you can get a recession out of this just seems kind of silly. Might it be a recession on paper like we've talked about in previous episodes? Sure. I mean, I guess if you get a couple of negative quarters of GDP, but all you're doing is basically just pushing back that growth to a future quarter in terms of accounting. In terms of reality, it's already there. But in terms of the accounting, again, when it actually gets captured by the numbers, that may just happen at a future time.
Yeah, so that's really an interesting point because the market now is discounting. And you and I think I've been on the track that we would see a recession, a paper recession, because of the pullback in government spending and support that we saw, which was completely inefficient and inflationary under the Biden administration. Not that we wouldn't see the longer term growth potential there. And we're seeing that in the investment, the private investment, but that in the short run, the kind of cleanup in aisle 7 was there was a large recessionary risk because of the shift in gears from a kind of a KFAB smokescreen policy and large deficit spending to the reprivatization of the economy. Right. And I think that and so I kind of feel the same way still. I feel like we may see a paper recession, but I definitely feel like the paper recession will actually feel better than the good times that the Biden administration and Yellen and Powell were telling us we were in the middle of, because during that administration and those 4 years, it was painful, but we were being told it was good. It's almost like this is going to be the flip. We're being told it's bad, but it's not going to be painful because we've already been through the real drudge and the real mud. The GDP numbers, I think, are really interesting. To your point, what was better on both ends was important. The private investment, intermediate, long-term, important. Imports, that big spike in imports, which was a drawdown on GDP, is actually short-term because that was kind of to front-run the tariffs. That number, because of tariff policy and the front-running fading, will actually improve as investments are actually improving as well. That's going to be a double whammy in a good way for GDP, and I see that as I've been talking about that kind of everything setting up for a very painful, 1 to 3 quarters, 3 to 9 months, and then a real setup for a V spike recovery coming out. I think that that's kind of my view of it, and I think it matches exactly your assessment of the numbers. Do you agree with that? Is that kind of like a good trader's view of your policy assessment?
Yeah, Anthony, I think that's spot on. It's like alcoholism. Under Biden, the economy was getting drunk, and you look at that and you're like, oh yeah, I feel great at this moment. Yeah. And then the next day comes the hangover and you feel really lousy. But the hangover is when you're sobering up. The hangover is when you're actually beginning the process of getting healthy. It was when you felt good that things were actually going downhill. Now, and in the same token, you can see here, this chart is government jobs. We're going to see, I think, the same thing with employment that you're seeing with GDP. In other words, as the government spends less money, that causes a drag on GDP. Well, as the government hires fewer people, you're also going to see a drag on the jobs numbers. And we now have had every month this year, what a difference a president makes, right? Every month this year, you've seen federal employees, get rid of the Postal Service for a second. Let's just look at the bureaucrats here in DC. Federal employees, by that measure, have been dropping. Again, all 4 months. That's tremendous news. And you're seeing the overall jobs numbers, therefore, essentially the growth in the private sector is more than making up for the decline in public sector employment. So all of these jobs numbers you're seeing, remember that it includes a loss of federal workers, which is a loss but a gain in terms of the overall economy, because these are people that are going to have to leave unproductive work and go do productive work where they will, again, actually add to economic output. That's a win-win in my mind. But once again, it shows up in the statistics as a negative. I mean, it was, we forget just how big government hiring got under Biden. I know you can see a bit of it there in terms of the increase in the graph, but yes, it's hundreds of thousands of employees, but there was literally 1 month in the Biden administration where, not going by the survey of establishments, but going by the survey of households, the number of people who reported working for the government rose by 700,000, the most ever in a single month. And that caused the unemployment rate to drop a couple tenths of a percentage point, whereas it should have increased a couple tenths of a percentage point, but for all that government hiring.
And I have to just touch on this for a second, because we've actually been talking about GDP growth, real GDP growth, and real employment and quality of non-farm payroll jobs. So quality of jobs, what's funding the jobs, and GDP growth. We really have been on this for well over 6 months, close to a year. Mm-hmm. When we look at these numbers, do you feel like it was... Look, I feel like this was a very shrewd setup by the Biden administration to create a false narrative and a smokescreen as far as what was actually being done as we were breaking the system in other ways. And I won't go into the border, but that's the first thing that pops into my mind. So do you feel like these policies that were in place were actually put in place? You give them credit for being shrewd, or do you think this was just missteps that created these issues within our economic numbers, our deficit numbers, our employment numbers? Or do you think there was some strategy here?
I think there is definitely some strategy, especially when you start, delving into some of the mechanics. And we've discussed before, for example, how Janet Yellen was trying to use what basically amounts to yield curve control and a fiscal infusion to counteract the monetary tightening that Powell was doing. So in this case, she stopped issuing so many Treasury bonds and Treasury notes, because those are longer and midterm securities. And she started issuing a ton more T-bills, because those are all short term, right? I mean, the longest duration, the longest maturity is 52 weeks. So what happens is, because they did that, these securities that are traded much more like cash, they have less of a liquidity premium, if you want to call it that, or illiquidity premium. Yeah. And it worked to effectively increase the things in the economy that could be traded like cash. In other words, it increased the overall money supply, or money substitutes, mm-hmm. and that counteracted about $1 trillion of drawdown that the Fed was conducting in terms of reducing money and money substitutes. It helped keep inflation going, but it also helped keep equity prices buoyed. And so as the current Treasury Secretary starts to undo that, again, you're now going to have to undergo the pain of basically taking all of that fiscal stimulus, if you want to call it that, out of the economy. And this is part of the reason, I think, why your call was so astute back in December, when you said, look, we're looking for lower values on the S&P, because so much of what had been done to, again, artificially buoy these equity prices, to artificially prop up a failing housing market, a failing job market. I mean, you name it, just about everything. All these Band-Aids everywhere across the economy. It was bubblegum and baling wire holding the whole system together. And now, as we undo all of that, from a policy standpoint, it's going to spill over into the profit standpoint as well. Again, going back to that alcoholism example, we're sobering up this year, and it's going to be tough. And I would love to hear from you, Anthony. Where are we now in terms of what are the numbers looking like? What's the model looking like? There's been so much movement, obviously, in the market recently. How has that been affecting your outlook?
Yeah, so as far as the numbers go, I was just looking at the S&P forecast for Q2 25, Q3 25 earnings, and it is amazing to me. The reports are coming in mixed, with definitely a markdown in estimates moving forward, and forward estimates. Some of the guidance has completely been pulled. And it's amazing to me to see the street blame everything on Trump and the tariffs. I said the other day, it was TDS, right? It was Trump derangement syndrome. and now we've moved to tariff derangement syndrome, and then we'll just get to a new one. But so just real quick on the fundamental aspect of things, which is not my wheelhouse, but on a top-down basis, Q2 25 earnings for the S&P through the January through today have gone from about 11% year-over-year growth to about 5%. Q3 has gone from about 14% to 9%. So what's funny about this is as you read this and you look at the distributors of the data, they say that there's been a massive drop in estimates coming out of Liberation Day. Mm-hmm. But if you look at the estimates, they were actually guiding lower and trending lower for months ahead of that. They just kind of forget that left side of the line and they focus on the right side of the line. So estimates coming down, guidance sometimes being pulled, coming down. I don't think the S&P 500 was way over its skis, as we've discussed, over-levered, overvalued. Market breadth was way too tight, which is a double-edged sword. As those names rallied, the market exploded, even though the troops weren't following. Now, the troops are trying to move higher, but you'll notice the S&P is struggling because those tech names, those Mag 7 names are not. And that's the problem, that's the double edge of the sword that we're witnessing right now. As far as the market goes, I ran 2 days ago. I have my chart up from the report I dropped 2 days ago, obviously my morning report. Mm-hmm. Back on April 25th, as the market was running off of the kind of breaking right above 5,500, closed right below 5,500, I had written in the morning report that I could easily see this counter trend bear market rally hitting 5,700. That level for me was an upside target for the rally and was going to be very, as far as I was concerned, major resistance for two reasons. It's kind of falling in between the 61.8% retracement for the entire bear market move, peak to trough, so the February high to the recent low and the April low. So that gives us kind of a resistance level on a Fibonacci retracement basis. It also, 5,700 marks the base of the topping formation that I started to talk about back in January. So for me, there was real consolidation, as we haven't seen recently, in that 5,700 to 6,100 range. So as we got up to 5,700, I projected that move up and felt like that would be a pretty sticky spot. And that's proven to be the case. So momentum and trend have increased and improved on the way off of the recent lows. We hit 5,700 2 days ago. We're currently at 5,630. And we actually were at 55.86 earlier today. This is the S&P Cash Index. So what am I saying? What I'm saying is I continue to pound the table. I am not a buyer or a chaser of these rallies until my models across the board, my momentum trend model in every timeline starts to at a minimum turn neutral or positive. I do not chase these rallies. I have been short to flat since December. It has worked extremely well for us. I will continue to do that. I think 5,700 will act as real resistance, and I expect, as I wrote this morning, that this fade off of 5,700 will continue. We'll head back towards the 5,000 level, and to wrap up, I do see us hitting 4,200 to 3,700 as the ultimate low for this bear move. My opinion has not changed. If it does change, I'm more than happy to make money on the upside, and I have, and I will. It's just not time to do that. So 5,700 firm resistance. Keep an eye on it. Watch for a fade now in the indices. We have Fed this week. There'll be some noise. The bottom line is I think this bear market rally has run its course, and I would look to start to get short as my momentum trend model on the daily shifts back to neutral, which it looks like will be neutral today, and then probably shifting negative in the coming, I would say, 4 to 6 trading days. That would be the call here. Overall, greater risk is definitely skewed to the downside, and that's how I'm playing this. We are up about 33% year to date. We've had no drawdown, and I'm not changing my strategy until I'm given a reason by the market, and right now the market's not giving me a reason to.
So, Anthony, let me ask you then, in terms of, as we move forward here, I'm so glad you brought up the Fed, because every time Powell gets up to the microphone, he speaks out of both sides of his mouth, right? And, he'll use the dual mandate as an excuse very often to do that. But whatever the case, do you think today, well, I guess more so tomorrow when he gets up to the microphone for the announce the rate decision and hold a press conference, are you anticipating that being another instance of the headlines are interchangeable and he'll say some positive, he'll say some negative, and Wall Street is just going to latch onto the negative and run with that?
Yeah, I think that's exactly the point. That the headlines are interchangeable. Powell has had a really kind of like the dual mandate for Powell over the past 2 years has been really, really bad communication and really bad policy decisions. So he's batting 1,000 as far as I'm concerned.
Yeah.
I expect, and we can go back to Jackson Hole in 22, where he completely started to collapse the market with his rate call. And anyway, I think we will see a pretty poor performance by Powell. I think he's getting some pressure from Trump. Yesterday, President Trump was out saying, I'm not going to remove him, but I want rates lower. I don't think Powell is going to deliver, whether it be in communication or whether it be in policy. And I think the market is shifting slowly back to the idea of we need the rate cuts from the Fed in order to get the market to move higher. It's really the Fed put, and that trade has more than run its course. I don't see how he can come out and say anything uber positive or do anything that's really going to jolt the market. We may get an initial positive reaction if he's dovish and he talks about cutting rates in the future and he talks about, but the bottom line is he's just proven himself to not cooperate, whether it be market running up or market selling off. He always seems to be swinging and missing. And I don't think this will be any different. I really don't.
Yeah, I got to agree with you there on all counts, Anthony. I mean, when has this guy ever gotten the narrative right? I mean, when have his predictions ever been right? He's just been wrong time and time again, whether it was on, where inflation was going or where interest rates were going or the impact that either of those were going to have on the banking sector specifically or on the economy broadly. I mean, it's scary when you think about it that he's the man at the helm in terms of monetary policy, but I guess we're stuck with them till next year, or at least until the tariff fight settles down and the markets can take a little more instability and go with Trump firing him.
Yeah. I think I think that's exactly the point. I also really, in my gut, I do feel like he's politicized just from the decisions he's made and the comments he's made.
100%. Yeah.
And Yellen was the worst. I mean, but I do feel like he's politicized, and I do feel like his decisions are not really data dependent, and they're not really in the best interest of the country or the economy or monetary policy. And that's a dangerous thing. It really is. And it's the type of thing that you can't really call out too loud, because then you look like the lunatic and you'll be attacked, and you'll not even that President Trump or the administration would be afraid of that, but it's a distraction from what we need to really focus on. And I think that the improvement in policy, the improvement in the economy, the rebuilding of our workforce, the privatization of the economy, everything we're doing is going to slowly just tighten the noose on him and get him to either exit stage left or play along. I don't think it's a headline thing or a criticism thing. I think you just have to create such a tidal wave of where we're going that he kind of just gets swept up in it, because right now he is not he's not on board, and that's really scary to me that he's not on board. But the government is filled, local, state, and federal level, with people who are just not on board with America succeeding. I mean, I jotted this down this morning. This is like a perfect, not even away from elected officials, real quick. But Mark Rowan at Apollo Asset, and this is just one comment of asset managers, large asset managers in this country, talks about President Trump damaging the brand of the United States. I've heard so much about damaging the brand. American exceptionalism is dead. The U.S. Treasury is dead. We're not the safe haven anymore. Like, just stop. Just stop. Let's be objective and let's move forward. For 1 second, be somewhat patriotic and objective and move forward, instead of this constant barrage of fake news, fake headline sound bites which attack Trump. But I want my portfolio to go up, but I want Trump to do bad. Like, you can't have it both ways. Just stop. And these are the same people, by the way, that had no criticism of Biden through the entire time, or Yellen, or Powell. So I've had enough. Leading us to, how dumb is I heard a comment this week that has blown me away, and I'm going to have a one-liner after we're done listening to Ilhan Omar and her "How dumb is" comment for the week. So how dumb is Ilhan Omar?
I would say our country should be more fearful of white men across our country, because they are actually causing most of the deaths within this country. We should be profiling, monitoring, and creating policies to fight the radicalization of white men.
Okay, so here's the thing. And this is really, I'm not even laughing because it's so scary and it's so important. First of all, you have no facts to support what you're representing as facts. And second of all, I would challenge everyone to replace the word white with black, and then ask yourself, is what she said okay? Because it's not. It's disruptive. It's destructive. It is absolutely unacceptable. And if you can't replace the word white with black and still be okay with that statement, you should in no way, shape, or form be a supporter of this woman. This is a joke.
Yeah, but Anthony, you know, those scary white men out there, you know, inventing things like airplanes and semiconductors. I mean, do we really want that kind of productivity in our society? Do we? No.
Those scary, radicalized white men, they are rampant in our streets. I will say this too. I have seen a lot of videos and a lot of news reports and a lot of cars being burned, materials being destroyed, houses, businesses, people being attacked and murdered. I would like her to support some facts on how many of those attacks were at the hands of a radicalized white man in this country. Again, let's just get a grip. And if you're not on board, it's an open border on the way out. Feel free. See ya. I'll pay for your ticket. Anyway, my friend. What's that?
I'll chip in.
Yeah. I love it. I think, yeah. All right, the good, the bad, and the ugly this week. Sir, EJ, have a great week. Thank you so much for the time. Great analysis on the GDP and jobs. Keep an eye on this and see if this recession really hits or what it looks like. And then obviously we'll see what the market reaction is. But tomorrow with Powell speaking is going to be important, and we'll recap that next time.
You got it, Anthony. Thank you for all your analysis on the market. Appreciate it.
Thank you, sir. A pleasure. Talk to you soon.